Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Monthly F&O settlement sparks heavy volatility on Dalal Street. Cautious global cues amidst persistent geopolitical tensions keep traders on tenterhooks. The action remains largely stock-specific. The sensex and the nifty end a little over 1% higher. Netflix cracks down on password sharing, and that seems to be working. The streaming platform delivers a strong Q4 as 13 million new subscribers take its total paid subscriber base to a record 261 million. Net profit up over 16 times year-on-year to $937 million, way ahead of street estimates. The stock surges towards a two-year high. CNBC-TV18 accesses a letter written by Z promoter Subash Chandra to Finance Minister Nirmala Sitharaman a week ahead of Sony pulling the plug on its proposed merger. In the letter, Chandra raises concerns over the timing of Sebi's probe and seeks the minister's intervention to safeguard the interests of Z's minority shareholders. Sebi remains firm on the January 31st deadline for high-risk foreign portfolio investors to disclose granular details on their India AUMs. Sources suggest that FPIs, which may be required to provide enhanced disclosures, may be significantly lower than Sebi's initial estimates. Homes with solar rooftops may be in for more financial incentives. Sources say the government may be considering a significant hike to subsidies, suggest the move would mean an additional outlay of 40,000 crore rupees, but add that no financial decision has been taken just yet. Reports suggest Israel and Hamas are inching closer to a 30-day ceasefire, even as thousands of Palestinians flee Israeli bombing of the city of Khan Yunis. UN Secretary General Antonio Guterres calls Israel's rejection of a two-state solution unacceptable. Trinamool Congress Chief Mamata Banerjee rules out an alliance with the Congress in West Bengal a day before Rahul Gandhi's Bharat Jodo Nyaya Yatra enters the state. She says the party will contest the upcoming Lok Sabha elections alone. Donald Trump wins New Hampshire's Republican primary, wins 55% of the votes, moves closer to emerging as a Republican nominee to take on Joe Biden in the presidential polls. Rival Nikki Haley finishes second, says the race is far from over. Well, those are the big stories that we're tracking this evening. But let's start with the market action. A very volatile day of trade on Dalal Street, which is natural for the day where we see monthly F&O contracts expire. But the volatility was also fueled by cautious global cues, this in the face of persistent geopolitical tensions from various parts of the world. Earnings season also means that a lot of the action was stock-specific. Key indices dipping into the red multiple times over, but finally closing in the green. 689 points higher on the sensex. The nifty put on about 200 points. The nifty mid-cap 800 points higher, and the nifty small-cap index also about 260 points higher today. So closing in positive terrain. That's the story for the markets today after that beating that they took yesterday, recouping the losses. BSE-listed companies have added more than 5 lakh crore rupees to investor wealth today. Prashant is standing by now with more details of the day's trading action. Prashant, volatile on monthly expiry day, as is to be expected, but does the late pullback give you an indication that the consolidation phase is over and the next series could bring more upside?
Shireen, it's a short work week, but there's no lack of drama, right? I mean, yesterday the market sold off about 500 points from the day's high, and today there was a 300-point pullback from the day's low. So, this is very unlike what the market had gotten used to in the last 2 months of 2023, when it was largely a smooth upward journey. This is turning out to be very different. We'll just have to see if this is just, a phase, or this is more like how 2024 is going to pan out. But it's a rocky start. I'll just tell you what we did. As I said, the Nifty, very strong gains, 200 points on the day and 300 from the day's low. Bank Nifty, no real help from that index. Banks continue to hurt. Broader markets did well. The mid-cap index was up about 2%. The small-cap index also doing well. And sectorally, the big gains coming in from the public sector space, the Nifty PSE index, the top gainer. Metals also got a bit of a sugar hit. And I'll talk about this in just a bit from now. So, stock-wise, as far as large caps are concerned, the gains coming through in names like Hindalco, Tata Steel, JSW Steel, a lot of metals. The news was China to cut their reserve requirement for banks, and Hang Seng did well. Actually, the Hang Seng index is up 5% over the last 2 days, and here, metals responded. Other nifty stocks, DRL, HCL Tech and IndusInd Bank were the gainers. Under pressure, actually the Nifty Private Bank Index was the only one which was down, and the reason is on your screen. ICICI Bank and Axis Bank both lower. In the broader market, it's a long list. As I said, the PSE, the public sector index, is the top gaining sector. And look at this. It's not just railways or banks. It's actually just sector agnostic. So IRFC, REC, NHPC, huge volumes on all of these. PFC, IDBI, NBCC, HUDCO, SJVN, IFCI, NALCO. I mean, this seems like, funds participating. There are lots of these individual public sector funds and schemes which mutual funds have launched. And I think there is money going into many of them because this looks like that. Some other stocks like Z, I mean, yesterday was a 25-30% cut, 7% bounce today. Indus Tower bounced and Borosil Renewables bounced for the second day, ending about, I think, 7 or 8% higher today. There was Midhani, KEI Industries. We had the KEI management earlier. Results were good. Management commentary was good. And Motilal came out with numbers during market hours. Some pullbacks as well. Max Health, Oberoi Realty for the second day running. Tata Elxsi sold off. You also had Karnataka Bank, which sold off on the back of weak numbers. Tanla and Ujjivan are some of the others that I just want to put out. I mean, I think we need to wait and watch whether this pullback is, temporary, whether it fizzles out. And how will we know? We'll know about 50 or 60 points above where we left off yesterday. 21,525 is the 40-hourly exponential moving average. And that's the closest resistance level that many will track to gauge whether we are able to build on today's gains, or once again, like what we've seen over the last 5-6 days, gains and pullbacks are only very temporary. Back to you.
All right, Prashant, many thanks for joining us. That's the market action for you, but it is earnings season. Tech Mahindra posting a strong set for Q3, beating street estimates on revenue. Rima standing by now with the fine print of the numbers. Rima, Tech Mahindra.
Well, the key highlight for Tech Mahindra is the revenue beat. The street was anticipating a decline in the top line, but this time the company has reported a constant currency revenue growth of 1.1%, snapping 2 consecutive quarters of a revenue decline. So that was the big positive. The company has said we've seen growth in manufacturing and healthcare, while communications, BFSI and high-tech continues to remain under pressure. Communications, remember, is their largest vertical, contributes about 40% to their top line, and here revenues are down 0.3%. The company's margins and profits are in line with street expectations. So EBIT margins have come in at 5.4%, an expansion compared to the prior quarter. The reason why Tech Mahindra's margins are in mid-single digits, while peers, whether it's mid-cap or large-cap companies, have much higher margins, is because the company is pruning their unprofitable business. They're exiting some projects where the margins are on the lower side, and this reorganization has hurt the company's margins for the last couple of quarters. Profits have gone up by 3.2%. The total contract value, that's the deal wins announced by the company, has also slipped on a quarter-on-quarter basis, coming in at $381 million. So that's a bit subdued. But on the whole, there is a revenue beat. The question is how much of it is in the price, because today the stock closed up with a gain of 3% in anticipation, perhaps, of decent numbers. And we've got that this time. Back to you.
All right, Rima, many thanks. That's Tech Mahindra ahead of estimates. Market regulator Sebi, we learn, is showing no indication that it will extend the deadline for January 31st, that is for high-risk foreign portfolio investors, to disclose granular details on their assets under management in India. Yash is standing by now with insights on the market regulator's thinking and what kind of impact this could have for FPI specifically and the Indian equity markets in general. Yash, many thanks for joining us. Take us through what is the thinking at this point in time as far as the market regulator is concerned? No extension, that is a given. But what could the impact and the implications be?
Well, the deadline for market regulator Sebi's mandate to secure additional disclosures from high-risk foreign portfolio investors, that ends on January 31st. First things first, who are these high-risk FPIs? To put it simply, they have to meet either of the two criteria, that is, having more than 50% of their Indian AUMs in a single corporate group, or the value of their India AUM or asset under management should be over 25,000 crore. Now, what are these enhanced disclosures? The second stage, granular details on economic interest, control and ownership of these foreign investments is what Sebi is seeking. Now, these will help Sebi get the details on the ultimate beneficial ownership of these foreign portfolio investments. Now, these high-risk FPIs had time since November last year to submit the details when it comes to, these granular details, and that timeline ends on 31st of January. This brings us to the bigger question. How big are these high-risk FPIs? Sebi estimated high-risk FPI AUM to be around 2.6 lakh crore as on March 31st, 2023. This would be around 6% of the total FPI AUM and 1% of the Indian market capitalization. Now, since then, of course, the base has certainly increased, but sources suggest that FPIs, which may be required to provide enhanced disclosures, may have significantly, reduced than what Sebi's initial estimates were. So why is Sebi seeking these enhanced disclosures? Now, it has been observed that some of these FPIs have concentrated, and a substantial portion of their equity portfolio in a single company. In some cases, these concentrated holdings have also been static and maintained for a very long time. This could be for circumventing regulatory requirements such as maintaining the minimum public shareholding regulations. Further, having granular details on the ultimate beneficial ownership for various high-risk FPIs also protects against the risk of opportunistic takeover of Indian companies. Now, if these identified high-risk FPIs fail to disclose details by January 31st, they will have a grace period till February 10th. If the grace period is missed, there is no immediate deadline even then. These high-risk FPIs, they would have another 6 months starting February 10th to liquidate or rebalance their holdings to comply and move out of that high-risk category. Now, let's come to the final part, which are these FPIs, despite falling under the high-risk category, will be exempted. There are various of them, government and government-related entities like central banks, sovereign wealth funds, pension funds, public retail funds, FPIs which have a broad-based pool structure with widespread investor base have also been exempted. Apart from that, ETFs with less than 50% exposure to India and India-related equities will also be exempted. Also, FPIs whose holdings in Indian corporate is below 25% of their overall global AUM at a scheme level do not have to submit these enhanced details. Also, FPIs whose equity AUM is below 50% of the overall global AUM at a scheme level will again be exempted. Finally, FPIs which are unable to liquidate their excess investments due to restrictions like IPO lock-ins, also moratoriums and newly registered FPIs will also be exempted when it comes to giving these enhanced disclosures with market regulator Sebi.
All right, Yash, many thanks for joining us. Now, speaking of overhang, the shadow of a failed merger with Sony continues to hang over Zee Entertainment. In the latest series of developments, CNBC-TV18 has accessed a letter that Zee's promoter Subash Chandra has written to Finance Minister Nirmala Sitharaman. In fact, that letter was written a week before Sony pulled the plug on the proposed merger. In his letter, Chandra raises concerns over the timing of Sebi's latest notice to the company's former directors and alleged that this probe was an exercise, and I quote, to sensationalize the matter. Nisha is standing by now with more details. Nisha, take us to the key points Subash Chandra made in that letter that we've accessed.
That's right. We have accessed a letter that has been written by Subash Chandra to the Finance Minister, Nirmala Sitharaman, and that was a few days before the Zee-Sony merger deal was terminated. Now, in this particular letter, Subash Chandra lashes out at the market regulator Sebi and questions the timing as well as the urgency of the Sebi investigation, which is coinciding, remember, with a critical juncture of the Zee-Sony merger deal, especially when it's on a matter that is already on the company's records for a while. More importantly, Subash Chandra seeks Finance Minister's intervention to really safeguard the interests of the minority shareholders of Zee, who, remember, have suffered a blow due to the termination of the merger by Sony. Now, he also goes on to say that Sebi is acting with a predetermined mind, and to support his particular argument, he also quotes an excerpt from the SAT, or Securities Appellate Tribunal order, in, remember, the case of Sebi versus Puneet Goenka, which overturned Sebi's interim order on removing Goenka from key managerial position. Now, SAT, in a scathing remark, had called it a manifest error on the part of the regulator to pass the order based on assumptions. Now, Subash Chandra seeking intervention from the Finance Minister also highlighted that India has lost FDI inflows worth $1.5 billion due to the Sony merger falling through, and there have been efforts to scuttle this large transaction. Now remember, we have been reporting and we reported on the informal negotiations and Sony's discomfort on Puneet Goenka's position as MD and CEO of the merged entity, which was part of the deal agreement, and according to sources, it became the key contentious point which led to the breakdown of the deal after Sebi opened investigations against the Z promoters.
Okay, Nisha, many thanks for joining us. Now, with the doors on the proposed merger with Z Entertainment closed, Sony Pictures Networks India is turning its focus back to the next chapter. In a letter to employees with CNBC-TV18 News Access, MD and CEO NP Singh says, and I quote, "We will actively explore new organic and inorganic possibilities to strengthen our market presence. Our immediate focus will be back on unleashing our full potential, continuing to craft content that not only engages our audience but also boosts subscriber growth and revenue." Back to earnings, Bajaj Auto out with its numbers. Sonia standing by ahead of estimates, Sonia.
Oh, absolutely. Very good set of numbers coming through for Bajaj Auto this time. A net profit growth of 37%, well above what the street was expecting. 30% is what the company seen, and an EBITDA of 36%. Across the board, it's a beat on all parameters for Bajaj Auto. But what particularly stands out to me is the domestic mode business has delivered a volume-led revenue growth of nearly 50%. This time around, has also a double-digit year-on-year revenue growth that exports have come to the surplus stock.
Sonia, we have you on Apache line. That's Bajaj Auto for you ahead of street estimates. Strong numbers coming in for Q3, as Sonia was pointing out. On to CNBC-TV18 exclusive. Top sources at HDFC Bank have told CNBC-TV18 that the management believes it is a fine growth machine and that the team can create another HDFC Bank every 4 years. We also learn the management is not particularly perturbed by the recent fall in the company's share price. It blames this on misgivings about Sebi's rule on the disclosure of beneficial ownership. Lata joins us now with more on this exclusive. Lata, many thanks for joining us. The stock has been under pressure, but what are we picking up in terms of management confidence from here on?
Yeah, the main tenor of the bank management was that it is as good a growth machine as it has been in the last 25 years. Remember some time back, the new managing director, Shashi Jagdishan, had said that the bank can create an HDFC once in 4 years. Now, there was some doubt over it after the latest quarter, but the top management speaking to us was saying that, this is a 4-year program and, we are only 1 quarter into the merger. There can be bumps, and the road bump this time was RBI's tight liquidity policy, and of course that incremental CRR, which made deposits expensive. But they have 4 years to prove their merit. And, there is a secular story which will unfold. In fact, they already point out that when it's a question of creating deposits, they have done better than any other bank and better than themselves. The bank is still accounting for 19% of the incremental deposits in the system every quarter. I mean, the quarter ended December 31st, as well as in the previous 9 months, as well as in the previous 5 years. For a very long time, they have been able to create that kind of deposits, and they continue to do so. They also point out that even in this very difficult situation where people are moving from savings account to FD because of higher interest rates, their CASA or current and savings account growth has been better than most other banks in the country. They've also said that they've learned from the market's reaction now, and they will communicate more oftener and strongly in subsequent investor meets. Apparently, an investor day is planned in February. They said that their main message is that they want to prioritize margins. They've understood that they're not going to give up on margins, and growth will come as it comes. They pointed out that, they have inherited a large amount of HDFC borrowings. Those were not deposits, those were borrowings, and they will mature over the next 2 to 3 quarters. And they plan to replace some of them with even bringing down their asset book, selling off, running off some of their assets. But they expect a margin kicker as those borrowings of HDFC are replaced by low-cost deposits of HDFC Bank. So margins they expect are going to improve because of that. They don't want to give an immediate guidance on margins, but they see it as a secular story, that it will get to 3.4, 3.5. You know, the long-term story is going to be one of improving margins. They went on to say they are not at all apologetic about the merger. They're very proud of it, and they expect the mortgage business to give them a lot more opportunities to cross-sell products and, you know, other cross-sell mortgage to their other customers. They still believe that HDFC Bank's asset book, you know, their loan book is the best in class. Now, because there is a Goldilocks scenario, there isn't a premium given for HDFC Bank. But once the downturn or a slowdown comes, everyone will know whose asset quality is the best, and that is likely to reiterate the importance of HDFC Bank. Just a word on new branches. Okay, before that, the Sebi rule. The management also thought that they got an unfair, sell-off because the Sebi rule requires that big exposure to one stock. You have to reveal the beneficial owner, and that's why people were selling off. They say some of the funds have even approached them to write to Sebi. Sebi's understanding is that if there is big exposure to a company where there is no identifiable promoter, then those funds are exempt. But HDFC Bank people who spoke to us, the sources said that this is not very clear to the custodians. And so perhaps it has to be put in black and white for that rule to be implemented. Otherwise, they get impacted. There was market disappointment on new branches. You know, HDFC Bank said they will open 1,500 branches, but now they've scaled it down to 900. The management's, the sources' reaction was that that has got nothing to do with deposit creation, because a new branch doesn't give them too much deposits. Older branches give them sometimes 10 times, 25 times the amount of deposits new branches give. So that's not a big thing. Also, these new branches are stuck because there's the Reserve Bank rule that if you create 100 branches, 25 additional branches should be in unbanked areas. And now there is no fresh list of unbanked areas. Almost all of the country has been already banked. So even their conversion of HDFC, you know, the old HDFC branches into bank branches is stuck because they don't have a clear list of unbanked areas. So this was the reason why there was some difference between what they promised and what they could deliver. That's the sum and substance of what these sources told me.
All right, Lata, many thanks for joining us. Let's see if the market takes note of what Lata is telling us. The management at HDFC Bank sanguine about the growth prospects and not particularly perturbed by the way that the stock has been reacting of late. Tensions in West Asia continue to escalate even as talks for a ceasefire continue. Reports suggest that Israel-Hamas conflict, which has now entered 110th day, may see an agreement on a 30-day ceasefire in Gaza being reached soon. But experts point out that there is still a lot of ground to cover as far as fighting in the Gaza Strip continues. Now, the Red Sea continues to be on red alert. The U.S. military has carried out 2 more strikes in Yemen, claiming to have destroyed 2 Houthi anti-ship missiles aimed at the Red Sea. The pressure on this key maritime route has deepened. There were also tit-for-tat aerial attacks by Iran and Pakistan on each other's soil, causing worry of a widening regional conflict. So where does this leave the state of energy security in this situation? Also, how badly is the supply chain being impacted? Joining us now to take us through that is Gaurav Ganguly, Senior Director of Economic Research at Moody's Analytics. Gaurav, many thanks for joining us here on CNBC-TV18. Take us through the key pressure points at this point on the back of the attacks that we are seeing and the impact on supply chain disruption and how large that is already.
Thank you for having me on the show, Shireen. So I guess the first point to make is that the Red Sea is seeing a reduced volume of traffic flowing through it as a result of the attacks around the Gulf of Aden and the Bab el-Mandeb Strait. But the Suez Canal is not closed for business, and this is quite important. The volume of shipping that goes through the Suez Canal has, however, declined. So compared to a year ago, the volume of shipping that is currently transiting the Suez is roughly halved. And the remainder of the traffic, and this is primarily traffic from Asia to Europe and back, that's having to go via a longer route around the southern tip of Africa. And depending on whether we're talking about a bulk carrier or a container ship, the bulk carriers have a lower speed, have a slower speed. The additional journey time can be between 8 and 18 days. So clearly, this is adding some friction to the global economy at a time the global economy requires less of that sort of stuff. Now, how much is that actually affecting supply chains and the global economy through things such as impacted industrial production or inflation? Well, the answer for now is not that much, and that's good news. We've heard of disruptions in automotive production in Europe. We've heard of high-profile cases such as Tesla and Volvo calling for pauses in production. We've heard of retailers talking about shortages, but what we're not seeing right now is a massive increase in costs and a breakdown in supply chains. We're just seeing some stretching of these supply chains. So the overall story for now is that industrial production, at least in Europe, is likely to take a little bit of a hit in the next few months. Same thing could happen in parts of Asia. Supply chains will face difficulties, but shipping will continue and we'll have to try and normalize. So that means things like longer shipping times, companies having to think about their inventory situation, having to deal with higher costs, etc. But overall, we think that this kind of a situation, as long as it remains contained, will not have a huge impact on the global economy.
Gaurav, you're right in pointing out that the impact so far has been limited, but were this to continue for the next few months, and we don't have any indication of hostilities abating at this point in time, are you factoring in, for instance, if this were to go on for the next 6 months or through 2024, specifically as far as inflation is concerned, because on some routes we have seen a doubling, in fact, of freight costs. So, the impact, at least on inflation, on costs, what could that potentially mean?
It's a good point that if the longer this continues, the more likely we are to see a significant impact on prices, for instance. We're right now assuming that a lot of this sorts itself out by the end of the first quarter or perhaps sometime in the second quarter. But if it continues over a period of 1 year, for instance, then we are looking at a slightly different scenario. But that said, we should take in mind that shipping costs account for a pretty small fraction of total goods costs. So provided shipping costs don't continue to escalate and get to the point that we saw perhaps back in 2021 during the pandemic, which was a very special case, provided we don't get to that kind of a situation, it will still have a very small impact on inflation. If I give you the example of Europe, European inflation is coming down. In the Eurozone, which was very heavily impacted by the Russian invasion of Ukraine, the fact that price growth is slowing and inflation is coming down reflects the normalization that's occurred over the course of 2023. Now, inflation should get close to target by the end of this year. If we see this current situation persist for the next 6 months, and if freight prices remain where they are, that's still not going to have a material impact on European inflation.
Well, that is good news, and that's good to hear. And our hope certainly is that this is going to be contained and will not result in a protracted series of events in the Red Sea. Gaurav Ganguly, always a pleasure. Many thanks for joining us here on CNBC-TV18. That's Moody's Analytics with the impact of the attacks currently on in the Red Sea on global trade and shipping specifically. That is it on this edition of Business 360. Do stay tuned. A lot more coming up right after this short break. We're back in a moment.